want to start with a broad overview of the uranium sector, the macro, because I think we have some people here who are perhaps a little bit newer to the space. When it comes to recent catalysts, we've heard a lot about AI data centers, small modular reactors, and obviously the main theme underlying all of this is a production shortfall. There is not enough uranium being produced today to meet current reactor demands. But I would like to hear each of your opinions on the current macro setup for uranium. What makes it an attractive investment opportunity at this point in time? And we'll start with you, Nick.
Sure. I mean, you've got a Trump administration coming in that's already been very vocal about promoting nuclear. You've got incoming DOE head in Chris Wright that's been vocal about wanting to expand nuclear. Even the Treasury Secretary during his confirmation hearing last week was talking about not a clean energy race, but an energy race with China, who is building coal plants, who is building something like 29 reactors right now. And so that's one of the things I looked at. I look at these climate targets. You know, we had a COP meeting late in 2024 where 31 countries agreed to triple their nuclear capacity by 2050. That's up from 20 countries the year before that, so a 50% increase in the number of countries who said they want to triple nuclear capacity. And then maybe a technical catalyst, I just look at the uranium price chart, right, which went all the way up above 100, and we had a nice consolidation year last year. And you know, if you're a chartist, it's looking like a cup and handle, if you will, where uranium prices want to go back up. And so I think that, you know, if they do start to go back up, that will attract eyeballs to the sector, re-attract eyeballs who may be disenfranchised with the sector over the past year. And those would be, I think, two of the key call-outs for me. You did a wonderful job summing up the what underpins this, the shortfall, the AI. And so, you know, I think let Trump get in and let's see if we can get some of these plant lives extended, which we've already started to see in the US, and maybe even a foray into, heaven forbid, constructing some new ones.
Absolutely. Jordan, what are you watching when it comes to catalysts in the uranium space?
Yeah, well, it was a great summary. Look, you have very compelling fundamentals. 200 million pounds of annual demand and consumption, 150 to 160 million pounds of primary mine supply. So the age of abundant secondary supplies come to an end. We've heard that time and time out. And whether it was downblending weapons, underfeeding, above ground inventories, that's coming to an end. So you don't have that buffer that we've had for the last 50 or 60 years. So as that depletes, the upward pressure on the price, not being able to tap into these secondary supplies is going to become more and more extreme. The other big factor is utility contracting. If you look historically, you hear about the long-term market, the long-term contracting market. It was somewhat anemic last year. That's one of the reasons that you had a bit of a sloppy uranium market, especially towards the end of the year. Only 106 million pounds that were contracted by utilities in 2024. That will change this year. I believe this year we will see replacement rate contracting volumes north of 180 million pounds a year, as in particular Western utilities. Not only do they need that long-term supply, but they have to restock, right? They've been drawing down inventories, they've been flexing up contracts, so they can defer these contracts and contracting, but they can't avoid it. So that's a big one. Touched on here on the demand side. Look, you have places like China planning to build 150 new nuclear power plants over the next 15 years, 10 a year. You've got other countries like India, parts of the Middle East as well. And now with, I think, a general deregulation trend in United States and potentially here in Canada going forward and in other Western states, I think you're going to see new demand, whether it be through new reactor builds, SMRs, new big tech coming in. And that's the other thing that could be a big unforeseen catalyst that we wouldn't have talked about even a year ago. Imagine one of these big tech companies investing directly into a uranium mining project. I think that would really light a fire under the sector.
Fabi.
You mean your uranium mining project?
Fabi, what are the catalysts you're watching in uranium?
Well, if you're like me and you're an investor in the smaller end of the market, you have to try to understand what is going to move your particular stocks and not just the general equities and anything else. So what I look at is what retail looks at, and what retail looks at currently is the spot price. So there is a massive correlation of spot price moving and the smaller equities moving with it. So that is something that I keep watching, and I know that eventually, financial players are going to jump back in and bid the price up, is my belief, because the contracting has been thin volume-wise, but prices aren't coming down in the way that spot market has come down last year. And so I just want to acknowledge that, Lobo Tigre was right, in that we were all excited, and I had, a very high target for last year, spot price-wise, and it was more of a pause in the market. And we need to acknowledge that even though the spot price hasn't reached what is happening in the term market, I believe that it's just a matter of time. I really love reading sentiment. It's what I do online on Twitter all day long, and I really like that this crowd here is slightly thinner than some other talks and some other years, and this to me is a big thumbs up to it's time.
Excellent. Rick, what are you watching?
Well, 3 points, and they've all been made, but I'll reiterate them. The basic supply-demand fundamentals for uranium are really good. I want to say that the easy money has been made. The easy money is made in the transition from hate to love. That's over. But I think the sure money is ahead of us. The sure money is ahead of us because of supply-demand imbalances. The sure money is ahead of us because the political winds have changed. 5 years ago, a guy like me in the United States would have been vilified for being in uranium, and now the morons want to subsidize me. Frankly, I felt more clean when they hated me, but I'm an old man, I'll take the money. But Fabi hit the third thing with regards to the stocks. I spend a bit of time on X, as some of you know, baiting politicians. And I've noticed that the posters that have uranium as part of their handle, uranium moron, uranium whatever. One of these guys last week said, the game's over, I'm out, I quit, screw you, strong letter to follow. The fact that this crowd is thin. I don't have the advantage of hate, which I love, but I do have a circumstance where the hot money is leaving the uranium trade in droves. And the first tick up, those morons are all going to come back. Being a pawnbroker to the morons is not a bad business, particularly when the underlying fundamentals are good. The most important factor, the reason I say that the sure money is ahead of us, is because this contracting thing changes the game. In my whole life in commodities, I've been a slave to the spot market. I could make price forecasts, and I mean, some of the forecasts I see out of the big investment banks, they could win the Canadian Fiction Award. They're just ridiculous. And in the uranium business, these people are signing contracts as much as 20 years forward. So a lender, which I am, can look at this, and you take the variability of price out, you can be a much more aggressive lender, both with regards to advance rates and term. Putting another hat on as a securities analyst, you don't have to rely on your own erroneous price forecasts. You can do volume and price 5 years out, 10 years out, 15 years out, 20 years out. There's no other commodity industry in the world where you have that top-line certainty that you have in uranium. There's two consequences to that. Over 5 years, the cost of capital to the uranium sector is going to fall, irrespective of any other resource sector, because the certainty is going to go up. That's the way that loan sharks like me do business. The second thing that's going to happen is that small companies with good deposits that don't have access to on-balance sheet financing, only access to construction, are going to be able to finance, because the counterparty is going to be an investment-grade counterparty. It's going to be a Southern company, a Duke Power. Whether they choose to build it or not is a separate circumstance, but the big boys won't be able to come in and say, you have to sell to me because you can't build it yourself. These guys are going to be able to say, well, in fact, I can build it myself, and if you don't pay me a fair price, I will build it myself. That's a huge difference. Now, for a lot of people, that's the imposition of reality, and they would prefer to feel rather than to think. And those people, well, mercifully, they're not here. That's the hot money. They're gone. So I really feel like I can sum up whatever I just tried to say by saying the easy money has been made. The easy money is made when somebody hates something, when everybody hates something. But the sure money is a consequence both of supply and demand fundamentals and a shift in the political and sociological circumstance around uranium, but particularly around the transition, the ultimate transition to the term market, which really, truly changes the game with regards to every other commodity in the space.
Now, there are very few publicly traded uranium companies compared to many of the other commodities out there, and the vast majority of them are not currently producing uranium. There's only two, Cameco and Kazatomprom, that are producing uranium in sizable quantities at present. There's a few producing smaller amounts. This makes the sector very difficult to evaluate, I think, for a lot of people, because you can't use traditional valuation metrics. Looking at the financial statements is an entirely different picture because a lot of these companies are not profitable. Most of them are not profitable. So how do you guys go about evaluating companies, say, in the exploration or the development stage? What are the main metrics that you look at? And Nick, I'll start with you.
Sure. Well, I look primarily at the exploration when I'm evaluating companies, right? So the first thing I always look at, irrespective of the commodity, right, whether it's uranium or copper or gold or anything else, is the share structure and the people, right? We've seen how the uranium market, even though we're in a bull market, has ebbed and flowed. And so structuring your company in a way that you can weather those ups and downs, those ebbs and flows of the industry is super important. And again, that's super important across any commodity when you're dealing with junior mining space. You've got to really understand where the shares are, how many they were sold for, where they're registered, et cetera. So that's just some, cursory due diligence, right, when you're talking about it. Given the events of the past year in the uranium space, I would probably also have to talk about jurisdiction, right, which has always been important to me as well. Have tended to stay away from certain jurisdictions because of the risk of nationalization, the risk of coups, et cetera, which, again, we've seen play out over the past year. So, and specifically, again, with this new incoming administration, it sort of makes North America, specifically the United States, a more attractive jurisdiction even than it was in the past 4 years. So those are two of the things I look at, and I guess just peeking at my notes here, people are important, just an extension of the share structure, right? And who owns them, who's running this thing, what have they done before? And then catalysts ahead, right? What are you trying to do? Are you a prospect generator, a hybrid? Do you have drilling coming up? Do your partners have drilling coming up? What are you trying to execute on? And really being firm in those timelines and how much it's going to cost. And as Mr. Rule likes to say, if that thesis changes, being willing to reevaluate or sell if that's the case.
And Jordan, what are the main characteristics you're looking at when you're evaluating uranium companies that are not yet producing uranium?
Yeah, I'd say, look, there's a lot of moving parts. Nick did a great job summarizing, I'd say, some of the main things. Obviously, you got to look at the management team, right? What have they done in the past? The technical team, the geological or the engineering team in particular, I think it's important to evaluate whether they know how to advance the specific project given the geology, given the jurisdiction, right? So it's great to have, dozens and dozens of years of experience, but if they've spent most of their career looking for uranium in Australia or in somewhere in Africa, doesn't do a whole lot looking for high-grade deposits in the Athabasca Basin, right? So you want to have people that have specific expertise in those specific jurisdictions. Now, you can use, a lot of companies aren't producing, as we know. There are government companies, SOEs, and other private companies that do produce a little bit, but the two main ones that you referred to are the main producers. There's a number of development stories out there. You can apply PNAB multiples. You can look at, enterprise value per pound metrics for companies that are in an advanced stage of exploration and or early stage development. So there are ways that you can evaluate these companies without your traditional cash flow models and valuation metrics. But when I look at exploration, our company, we're an advanced stage explorer, prospect generator, as Nick mentioned, and we're in the Athabasca Basin. One of the things that I think is important to look at for exploration companies, and Nick touched on it, it's okay, what's the potential upside, right? What kind of target are you going after? We know in the Athabasca Basin, for example, they're very large, high-grade deposits. But what is it going to cost you to get there? What's the dilution to get there? So, for example, you have very remote projects, very high-cost drilling, $800-900 all in Canadian a meter. That makes a big difference. You're drilling deep. That makes a difference. difference. If you can drill relatively shallow targets and keep your drill costs down, in our case, we have some of the lowest cost drilling, 350 Canadian all in a meter, that makes a big difference. Less dilution to get to that initial discovery or to expand an existing resource.
Great. Well, Fabi, I know you like the small caps quite a bit. Maybe you could give us some insights there to your approach to evaluating those companies.
So beyond everything that has been mentioned so far, I do like to compare like for like within the industry. So if you take jurisdiction A, let's take the Athabasca Basin, which is where Sky Harbor is at and very active, actually. If you take a look at different companies, they will all have, you know, the best project ever and the blue sky potential and everything that you're supposed to say when you're trying to sell the company. But if you compare market cap, then you're going to start to see that there is always something that is way off. So you'll always find a company that, compared to what they have proven so far, is, you know, highly valued. And I think it's important, especially for you guys are here and can walk the floor and talk to people, is to get to the bottom as to why does this look like it's more expensive or cheaper than the other companies. And you may not get the full story here, just talking to management, but also talking to other investors. Sometimes it's a matter of, we talk about the supply and demand dynamics of uranium, but I think you have to really pay attention to the supply and demand dynamics of the stock. So who is selling? Why are they selling? Why does it look like volume has dried up? Or why is there tons of volume? Who is unhappy about what's going on in the stock and why are they dumping the stock? Sometimes there is a half perfectly good explanation, sometimes there isn't. So doing, you know, asking the tough questions and doing the digging, I think can really pay off, because you'll find out things that, you know, that are difficult to find out otherwise unless you speak to the management teams.
Great. And Rick, some pointers on how you evaluate uranium companies who are not yet producing.
Yeah, I take a much different approach than these three people. I think it's fair to say that they're all probably better market players than I. I come in from a lender's viewpoint. So somebody shows me all their assets, and rather than focus in the first instance as to what could happen if everything can go right, because that almost never happens, I think about what happens when things go wrong. So somebody shows me 2 or 3 assets, and I think about, as a lender, if these guys went broke, which is the logical outcome for many of them, what can I liquidate the assets for? Their key asset is XYZ, blah, 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 blah. And if they happen to drill a good drill hole, you'll notice if, then it's a $1 billion company. But if I was to take it out on the street right now, sell it to a willing buyer, what could I get from it? If the market cap of the company is $100 million and the liquidation value is $5 million, I know I have to explain away $95 million somehow to myself. That turns out to be difficult. I know Warren Buffett once famously said paying attention to markets is problematic, because markets in the near term are voting machines. Markets in the long term are weighing machines. So when I pay attention to markets, that means that I believe that the way people vote is sensible. And I think the experience we've had over the last year would call that into question. So I look really at valuations. I look too, in small companies, at when they got in the business. If the management team failed at gold, and then they failed at pot, and then they failed at lithium, and now they come into uranium, you know, like, why would I want to be their 4th failure? It makes no sense to me. So I want them to have come into the space because they cared about uranium. And it would be useful if they had people on the board and in the management team that 5 years ago could spell uranium. And that's often not on offer. That's important to me. So I want a little bit of value. I want a little bit of skill. I don't think this is asking too much, by the way. And I want, when I ask them how they're going to add value next year, irrespective of the uranium price, what unanswered question they're going to ask with the drill bit, with an acquisition, I want them to tell me what the most important unanswered question is, and I want them to tell me how they're going to answer the question. I want them to tell me how much money it's going to take, and if they don't have that money, where they're going to get it. Jesse, fully 80% of the time that I've asked that question across mineral commodities for 40 years, the CEO has looked at me and said, that's really interesting. You know, I've never thought of it that way. Which suggests that to them, the only unanswered question is, am I going to get paid a salary in 18 months? I hope they get paid a salary, but I don't want to pay it. You know what I'm saying? So that's what's important to me. What's important to me is what happens at a very granular company level. The market's going to take care of itself. Really, truly going to take care of itself. The market doesn't give a damn what I think. I care about them on a company-by-company basis.
Fantastic insights there from all of you. Let's move to specific areas of the uranium market where you're currently seeing value, whether that's a particular stage of production, whether you want to talk about any individual companies that you happen to be investing in or watching at the moment and why you're bullish on them. This time around, Jordan, we'll start with you, and you could give an introduction to Sky Harbor Resources, why people should be bullish on the company and why they should be paying attention, and then we'll move on and get some specific stocks from the rest of the panel.
Great. Well, thank you. I don't think it's going to surprise anyone. I'm going to pick Sky Harbor Resources, but I said it. I won't spend too much time. Advanced stage exploration, one of the largest land packages, over 1.5 million acres. So I'd like to think we would have some residual value, Rick, if 2 of the assets don't work out. But one of the unique things for us is we've just raised $10 million. We're ready to go for our largest drill campaign ever at our 2 co-flagship projects. Both of these projects do have high-grade multi% uranium in previous drilling. So we're going to be starting that drilling shortly. Unique to Sky Harbor, we have this hybrid model and a very strong and growing prospect generator business that complements our exploration efforts at our 2 main projects. 9 partner companies spending potentially over $70 million across 13 of our other properties. They're drilling an additional 15 to 16,000 meters. So 30 to 35,000 meters, a good chunk of that funded by partners, less dilution for us, and a lot of shots on goal for new discoveries and resource expansion. Outside of Sky Harbor, Denison Mines is one as a developer in the basin. They're our largest corporate shareholder, so I am a little biased there. Their president and CEO, Dave Cates, is a director of Sky Harbor, but they're going to likely be the next producing new mine in the Athabasca Basin using ISR. Very low cost, relatively low development costs. The project, the mine itself, is just a few kilometers away from where we're drilling. Great management team, great technical team, so that's definitely a developer in the basin you want to be looking at. I do think you want some U.S. exposure. Obviously, with the election, I think the American market is going to do well as in addition to the Canadian market. So having some exposure in the United States, there's a number of companies, which I'm sure some of which are here, will be talked about. Yeah, keep it within North America. I'd say just there's too much geopolitical risk, and uranium is it's a very highly concentrated production profile. Stick to North America.
Great, and we'll switch things up and go with Rick next. Where are you currently seeing opportunity in the uranium sector?
Well, I have to say that my 2 top picks last year were failures. I liked Cameco and I liked Kazatomprom. First of all, the 2 of them are beefing, having a fight. That's not a good thing. One of the things I really liked about Kazatomprom was extraordinarily high-quality middle management. When I would interview these young Russians and Kazakhstanis, I was just blown away by their high caliber. The problem is, in the last 18 months, most of the ones I liked left. I have this bad habit of when the reason to own a stock goes away, the stock has to go away. So I've had to be selling my Kazatomprom. And Cameco did an acquisition that I thought was interesting but risky, which is to say they bought Westinghouse, and thus far the financial results have been disastrous. I was concerned owning Cameco as to whether they could operate a uranium mining company and an engineering company simultaneously. I think the jury's still out, but the preliminary indications are not good. So my 2 top uranium picks have been sales this year, unfortunately. I like the developer space because I think that developers that are willing to give up the sex of the upside in uranium's price for the stability of contract price take away my risk. Jesse, I'm old enough now, you can take away some of my upside if you remove all my downside. I'm really, 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 truly good with that trade. Below that, I want to be in the prospect generator space. If Jordan comes to me and he says, Rick, I got 12 projects, and I want to take you through all the projects, I'm less inclined to care about what I think, and much more inclined to think about what a partner thinks, if that partner's willing to spend money. Like, I could hire a good consultant to look at Jordan's stuff, and the first thing the consultant would do is he said, I need to write a consultant's report that will cause Rick to want to retain me so I could write him another report next year. Okay, I like guys trying to please me. But in Jordan's case, whoever writes the report has to accompany it with a $5 million check. In other words, he doesn't get paid, he has to pay. Now that's a true measure of whether or not he likes it. So in the exploration phase, I want to use other people's money. I want to benefit from the evaluation of a third party who writes a check. And I also want Jordan, because he could never afford all the technical experts that Cameco has and Denison has, to be able to access all those guys for free because they're spending checks on his ground.
And Fabi?
I've been talking about the USA a lot. I do believe that having some exposure to the Athabasca Basin is great and something that you don't want to miss out on, because when stuff is found in the Athabasca Basin, there's nothing quite like it. But I have been pounding the table about U.S. uranium for some time, and I think that with inauguration and everything that's going on there, and the fact that, you know, small-scale production is coming online slowly but surely, and we have deposits, known deposits, low-grade but known deposits all over the place. I believe that people who don't have any exposure to the U.S. sector, U.S. uranium sector, this time next year, people are going to really regret it because the writing's on the wall and it's kind of obvious. And a lot of stocks are down by quite a bit because sentiment is so bad. So I'm biased. I'm on the board of a company called Rush Rare Metals, and we did a deal with Myriad Uranium. We optioned it out to them, and they have found grades that, in all honesty, if we knew the quality of what they're finding, we would not have done the deal under the terms that we did the deal. So, yeah, I'm holding on to my shares, and I'm looking forward to next steps because I think the writing's on the wall in many ways for U.S.-based companies.
And Nick, what are you looking at right now in the uranium sector?
I think that given where we are after the past year, given the retracement that the equities have made, given that most people aren't willing or don't have the time to do the work necessary to invest in individual stocks on the small end of the spectrum, and given that those stocks on the small end of the spectrum are inherently risky, I like ETFs for most people. There's a lot of ETFs out there now at this point. A lot is a relative term because it's the nuclear and uranium industry and it's small, but there's more today than there was, 5 years ago, right? You can buy an ETF for the small end of the spectrum, a junior uranium ETF. You can buy a trust that owns, a physical uranium, and you can buy a larger ETF that holds some big board listed companies. And I want to talk about those for a second, right? Because when we saw the announcements of the past year, back to back to back, right? Microsoft, 3 Mile Island, Amazon, Meta, et cetera. It wasn't the uranium companies that took off, but it was the SMR companies, right? It was the NuScales, it was the Oklos, it was the utility companies themselves, right? Constellation, who then went out and spent, I think, $16 or $18 billion to buy Calpine, right? So those are very liquid as well, which allow you to get in and out. And I started this answer with timing, right? Where we are in the sector. It's a good time to get into those broad-based uranium equity ETFs, I think. And then I would echo Rick. I like what I would consider the developers, right? These are really small-scale producers, right? The UECs of the world, the Denisons, like Jordan was saying, Energy Fuels, Encore Energy, for example, because of their liquidity and because, well, it depends on the company, but they could be leveraged or unleveraged. But I like being able to get in and get out of those stocks. So that's where I'm spending the bulk of my time looking and investing at these days.
Fantastic. Some great insights from all of you. Let's finish with directing people to where they can go if they want to hear more from you. Rick, we'll start with you, and then we'll move this way.
Rule Investment Media, pitch goes like this. If you like what I have to say about resources, personalize it. Go to my website, Rule Investment Media. List your natural resource stocks, and I'll rank them 1 to 10 for free. Absolute money-back guarantee, because it's for free. RuleInvestmentMedia.com, list your natural resource stocks. I personally will rank them.
Fabi?
I have a free newsletter daily that talks about news in the junior mining industry, and I try to focus on the small companies and not so much on, large scale, big money. And it's called The Next Big Rush. You can also take that name, The Next Big Rush, and search for me on YouTube, Twitter, etc.
And Jordan, yeah.
We have a booth here, 804. Feel free to pop by. Our website is the best place. We have all of our contact info on there. I'm always available. Love to chat uranium in Sky Harbor. The website's skyharborltd.com.
Nick.
I'm digestpublishing.com. You can click on the publications button there. We have several publications you can sign up for, free and paid, depending on your interests and level of risk appetite. Digest Publishing.
Excellent. Well, thank you so much. A round of applause for our fantastic panel today.